Assalamualaikum warahmatullahi wabarakatuh. Hello everyone. We are from Group 6 of Auditing II in International Accounting degree. We would like to present about our presentation material with the title Audit of Funding and Payment Cycles. But before that, let me introduce myself and my group members. My name is Richard Julian Antonio, and my group members are Afelia Zahara, Fariza Mulyana, and Olivia Renata Putri. So there are 7 subtopics of our presentation. The first one is funding cycle basic concepts. Second one is funding cycle audit objectives. The third one is potential error. 4, preparation of funding cycle audit and implementation of audit procedures. 5, audit planning considerations. 6, substantive test of long-term debt balance. And the last one, substantive test of shareholders' equity or capital. And the first part will be presented by Afelia Zara. To Afelia, time is yours.
Okay, thank you, Richard. For the first is funding cycle basic concept. Funding activities include the transaction and event in which cash is obtained from or repaid to creditor as the financing with debt or owners as the financing with equity. This funding cycle is related to the transaction regarding to raising funds from the other parties like the capitalists, issuing bond, issuing preferred shares, or the ordinary shares, which are indeed as the capital injection, so the sales of the share of long-term debt. And funding activities also include the repayment of long-term debt that have matured, treasury stock, and interest and dividend payment. The cycle includes 2 groups of transactions. Namely, for the first is long-term debt transaction, which include the bonds payable, mortgage, notes, and loans, and payment of principal and interest. And the second is shareholder equity or capital transaction, which include the issuance and redemption of the preference shares and ordinary shares, as well as share repurchase transaction and dividend payment. The funding cycle intersects with the cash, namely because the payment of bond interest and dividend by the company is usually carried out in the form of money. And the related accounts in the funding cycle are, for the first is long-term debt transaction and shareholder equity transaction. In long-term debt transaction, we can see from bonds, mortgage, notes, and long-term loans. The second is bond premium. The third is interest payable, and the fourth is interest cost, and the last is gain or loss on the termination of bonds. And shareholder equity transaction from the preferred stock, common stock, share repurchase, paid in capital, return earning, dividend, and dividend payable. For the next slide will be presented by Olive. For Olive, the floor is yours.
All right, thank you, Afel. Next is funding cycle audit objective. The purpose of funding cycle audit is to test the correctness and reasonableness of management's assertion about financing transactions. Management assertions are management statements in the form of account balance in the financial statements. The criteria for the truth and fairness of funding assertions are the first assertion according to supportive evidence, second assertion according to facts, third assertion are fully disclosed, fourth assertions are in accordance with SAK. To ensure the effectiveness of the achievement of audit objective in carrying out audit, that is, the auditor needs to use a good framework. For example, using the framework developed by the Public Company Accounting Oversight Board, which consists of first, existence or occurrence, second, equipment, third, rights and obligations, fourth, assessment or allocation, 5, presentation and disclosure. Next will be presented by my friend. For Fahri, time is yours.
Okay, thank you, Olive. I will continue this presentation. The third is potential error. We can see the point of the potential error. The first is misreporting of account balance for funding transaction. For example, due to an error in the cut of transaction or intentionally not reporting long-term debt in full due to certain consideration. Second, funding process are not used according to the predetermined plan. Third, misuse of loan repayment fund by unscrupulous company staff. Fourth, errors in recording loan repayment. For example, misclassification of elements of repayment of loan principal and repayment of loan interest. Fifth, error in recording leasing payable due to misclassification between operating leases and financial leases. The next, error recording interest payable adjustment at the end of the accounting period. The seventh, error in recording interest expense, for example, because they do not take into account the amortization of premium or discount on bond payable. The next, error recording the conversion of bond payable to shares. And 9, error in recording share sales transaction with a subscription stock pattern, especially when the share subscriber failed to pay off the lack of share payment. The 10, error in recording dividend announcement and payment. For example, in the case of stock dividends or liquidating dividend. And last, error is in recording treasury share and resale of treasury shares. The next will be explained by Afel.
Thank you, Fahri. The next slide is preparation of funding cycle, audit, and implementation of audit procedures. For the first is issuance of bonds and common stock is usually the main source of capital funds. And the second is the funding cycle is related to the expenditure cycle when a cash is issued to pay bond interest, bond withdrawals, cash dividend, and the purchase of treasury stock. For the next slide will be presented by Audit. For the time for Audit.
All right, next is audit planning considerations. Some of the audit planning considerations include the first is materiality. Materiality, the significance of long-term debt in the financial positions of various companies may vary on difference. In general, in companies, the ratio of debt to long-term debt to total liabilities and shareholders' equity is not material, but in companies such as PLN companies, gas and water long-term debt, gas and drinking water long-term debt can reflect more than 50% claims on total assets will be more than 50% claims on total assets. The second is congenital risk. The risk of misstatements in performing and recording financial cycle transactions usually low, where in most companies, these cyclical transactions are rare except for payment of interest and dividends, which are sometimes handled by outside parties. Besides that, most of these kinds of witness transactions require authorizations from the Board of Commissioners and Commissioners officials. The third is risk of analytical procedures. It is an element of detection risk in the form of failure of analytical procedures to detect material errors. If the auditor understands the investment activities and the nature of the client's business, then the investment bank and the nature of the client business activities, client funding can be estimated. The fourth is control risk, namely the application of the components of internal control over transactions and balance in the income cycle is in many ways similar to what is applied to the investment cycles. As in a control environment, responsibility for transaction is usually assigned to the head of the company departments that must have the integrity and competence to perform this task. Most transactions, large transactions, require authorization from the Board of Commissioners and the Board of Commissioners audit commitment must audit closely monitor activity and controls in the cycles. The 5 is documents and records. A number of documents in the finding cycle, such as stock certificates and bond certificates, are viewed from the point of view, the issuer's point of view. In addition, transactions on the funding cycle involves entries in the general journal, cash receipt, and disbursement journal for issuance and termination activities and termination of debt financing, share securities, payment of debt, payment of interest payments, and dividend announcement and payments. The 6th is related functions and control. The functions of the funding cycle and control activities related to the funding cycles, which are granting authorizations and bonds and share capitals, issuance of bonds issued by the Board of Commissioners and share capital, payment of bond interest and cash dividends in accordance with the authorizations of the Board of Commissioners and management, repayment and repurchase of bonds, recording of spending transactions properly and correctly. The analytical procedure used to audit the funding cycles, which are free cash flow ratio, ratio of interest-bearing debt to total assets, the ratio of shareholders' equity to total assets. The ratio compares the return on assets to the incremental cost of debt, the return on equity ratio of common stock, the ratio of cost of cash flow from operations to dividends and current debt, the ratio of the number of times interest in earned, ratio of interest expense in interest payable. The next topic will be presented by Fakhri. Time is yours.
Okay, I will continue. The 6th topic is about substantive test of long-term debt balance. In general, companies have few transactions related to long-term debt, but the amount per transaction is often very significant. Long-term debt transactions rarely have a problem with the year at the cutoff. We can see this table, detection risk determination. In the initial procedure, the first gain an understanding of the business and line of business and determine A, significance of the different sources of funding, B, key economic drivers that affect a firm's need for financing and its ability to raise equity capital and dividend payment, and the last, an industry standard that show how far the industry use debt and equity spending and the impact of debt on net income. In second, perform initial procedures as on long-term debt balance and report that will be tested a later stage. The first, stress the beginning balance of last year working paper long-term debt. Second, review activities in all relevant long-term account payable and profit and loss account and investigate journal entities that appear unusual in the amount of source. And third, obtain a list of long-term debt from the client and ensure that the data in the list match its accounting record by the first, check the correctness of the descending and horizontal addition in the list and reconcile the amount with the long-term account, payable subsidiary ledger and control account balance. Second, check the conformity of the item in the list with the journal entity in the subsidiary ledger and control account in general ledger. In analytical procedure, we can see perform analytical procedure. The first, we calculate ratio, ROA, free cash flow, interest-bearing debt to total asset, and etc. And B, analysis of ratio and their relationship to forecast based on past experience, budget, industry, or other data. The next about transaction detail test. Do the matching of the journal entries in the long-term debt account and the related profit and loss account. In balance detail test, you can see review authorization and long-term debt agreement and confirmation of long-term debt with creditor or bond trustees. And the last, recalculate interest cost. In presentation and disclosure, compare the presentation in the report with GAAP. The step A determine that the balance of long-term debt have been properly identified and grouped in the financial statement. And the last, determine the appropriateness of disclosure with respect to all term, agreement, commitment, and determination provision relating to long-term debt. Okay, the next presentation by Richard.
Okay, thank you, Fari. And last subtopics is substantive test of shareholders' equity or capital. Testing of shareholders' equity balance can be performed before or after the balance sheet date. In auditing these balances, for the evaluation or allocation of and presentation and disclosure assertions, it is necessary to separate the paid-in share capital from retained earnings. Detection risk determination. Detection risk in equity is sometimes set low because transactions in equity occur non-routinely with the client firm, so detection risk can be assigned moderate or high if there are only non-routine transactions involving the issuance of share in acquisitions, convertible securities, or stock options. And we can see in this table for initial procedures, the first one is gain an understanding of business and line of business and determine A, significance of various funding sources or debt and equity. B, key economic drivers influencing demand the company will be funding as well as the ability to equity capital and dividend payments. C, industry standards that show how much the industry use capital expenditures. And the second one is perform the initial procedure on the balance of shareholders' equity as well as the records that will be tested further. And for analytical procedure, perform analytical procedures. Next slide, please. And for transactions detail test, there are 2 points. The first one is match all debits and credits to the capital account paid up shares with supporting documents. And second one, match all debits and credit to profit account detained with supporting documents. And for balance detail test, there are 5 points. The first one is review the articles in the company's articles of association. The second one, review the authorizations and terms of the issuance of shares. The third one is confirmations of outstanding shares with register and transfer again. The fourth one is inspections of share certificate book. And the last one is inspections of repurchased shares. And for presentation is disclosure is compare the presentation in the report with GAAP. And that's all about our presentation. Thank you for attention and close by saying wassalamualaikum warahmatullahi wabarakatuh.